Where can people find out more about Missional?
This is not a podcast, Nate. They're on our page. That's why they're watching this. You want to be a podcaster. This is just us chatting. It's just us chatting, man.
Well, what if they're not subscribed to our
All right.
newsletter?
All right. Go to missional.group, www.missional.group, or find us anywhere on social media. And we're going to try to do these once a month, just talk about the market. It won't always be Nate and I. Chris, Patrick, and Paul, they'll be jumping on here and sharing their thoughts as well. So it'll be kind of a neat platform for us just to communicate what we see in the market, what we see for our limited partners, and go from there. I think it's a great way for us to kind of stay connected with the community.
Good to see you once again.
See you all the time.
I know.
Um, And in fact, we saw each other in person last week. At,
That is correct. We converged at the best ever conference in Salt Lake City. Whole team was there, plus a few extra people. It was a lot of fun. For those who don't know what best ever conference is, Troy, you want to fill in the people?
yeah, this was my first time at the conference. Some of our other team members, missional team members, have been there before, but really, it's primarily focused on commercial assets, primarily multifamily, but there are some other type of syndications and sponsors there representing their deals. And historically, you'll see a lot of sponsors like us go connect with other syndicators, but also have an opportunity to connect with a lot of limited partners. And that wasn't exactly the case this year, was it?
No, and we had a little perspective on it because a couple of our partners have been the last 3 years, and so they've been able to see the trend downwards in the numbers at the conference. I believe at the height, maybe it was like 1,500, maybe more number of attendees, and I believe the official count was around 700 this time. So half of what it was a couple of years ago, and I think that pretty much follows the what the market's been doing. But then we also have, maybe some other theories of why that's happening. But really, um, it's been a tough couple years. And like we were just talking about offline here, in our next newsletter, talking about, affordability issues, but talking about like kind of coming out of the cave, like where are we at in the market cycle, given, commercial real estate, specifically multifamily, and our thesis around that. So specifically, I think our thesis has been, since we started specifically in the syndication space about a year and a half ago, was that we saw the market starting to change a little bit. It had gotten very frothy. People were,
Did you say
you know
froggy or frothy?
frothy.
Frothy.
Frothy, yes.
Yeah, it had, and to your point, I mean that was a lot of our driving reason to get into the market when we did, and to bring investors in because we just saw so many unqualified operators who really didn't know what they were doing. And man, I'll tell you, that was the theme of the conference. Not only sponsors who didn't know what they were doing, but even well. Um, Researched sponsors who have been in the game for a number of years. A lot of people got caught in the last couple of years, and that's had a real negative impact on LPs.
Mhm.
Um,
When you say caught, like specifically, what was happening, either the market or the way they structured the deals? What do you think was going on there?
I'm a firm believer that if you get your debt right, if you take out the appropriate loan and you're not over leveraged, you're probably going to be okay. And that was the exact opposite of what a lot of sponsors did. Even um, well respected sponsors, they went in, they didn't have enough cash in the deal, and they took out short term debt. And where I think where we're a little bit just stumped by why so many of these sponsors did that, they took out this 3 or 2, 3 or 4 year bridge debt, and they took it out when rates were at zero, and they didn't account for the possibility, and I say possibility lightly because where do you think rates are going to go? If you're taking out rates, if you're taking out a loan at historic low rates, really they only have one direction. Now,
They can't go
true,
down.
yeah, they really can't go down any further, but it's true. No one expected rates to jump as quickly as they did, and that was not expected in the market. However, it was definitely something that if you're a risk manager, you plan for. And a lot of these guys didn't. So, these properties that they bought with low leverage, or I'm saying too much leverage, I should say, and these low rates that eventually would come due and be refinanced at a higher rate, it's just wreaked havoc on these deals. And I mean, we're seeing a lot of limited partners who lost everything because that net operating income dropped significantly. They can't even service the debt. Occupancy has kind of leveled off, and rent increases aren't going up. So I would say, really, it's a function of poor underwriting that put these LPs in harm's way, and that's what we're seeing in the market right now.
And
Now,
that's probably a big reason why the conference was maybe not as well attended. There are some LPs that were maybe not really looking for a new sponsor to invest with. They're being extremely cautious right now. And in fact, the last year or so, at least I've noticed this more. There's a lot more people that are acting as almost like financial advisors to LPs. Like, how do you vet sponsors? How do you vet deals? What do you look for? Because so many people have gotten burned. I was looking at kind of to your point about how people were taking out floating rate debt. I was looking at a sponsor who's done dozens of deals yesterday, and they have like a track record of everything they've done, when they've sold, all that kind of stuff. And they were turning and burning these apartments like every 12 to 18 months. I mean, they wouldn't hold stuff for more than a couple of years. And a lot of LPs got spoiled in that regard because they could double their money in 2 years. And so, of course, a lot of money was flooding into the market. But right now, in the high interest rate environment that we're in, that's not the case. And values have come down, partly because of that. Some of the banks are kicking the can down the road. They're actually working with some of these sponsors. They're like, hey, we'll give you an extra year, maybe 2 years to get this sorted out. But I don't know if that's going to be enough time. And in the meantime, that means that they're either having to pause distributions or have additional capital calls.
any stories, Nate, that you kind of heard about in the conference that really stuck out to you? I've got
Yeah.
one in mind. I've got one in mind.
Okay. Why don't you go first? Yeah.
Um, Talking about an LP who was with the same sponsor, and this is why you've got to be very careful. You've got to diversify, and you have to look at every single deal and really dig into it. Um, there was a limited partner who had invested with the same sponsor for probably a decade, started with a small amount of money, continued to roll those dollars over into the next deal. All right. Thinking, well, the sponsor has been good. They've done well for me in the past. I'm just going to roll into the next deal. They built that small amount of money up to $3.5 million, blindly went into the sponsor's next deal. And it was a bad one. So all that work was wiped out, lost everything.
Yeah.
So one deal.
Right.
And when you look at the last 10 years, the market's done nothing but gone up. It's just gone straight up. It didn't matter if it was a good deal or not. Cap rates were compressing. Probably could have got away with that. But I would encourage anyone listening, first of all, diversify. Don't put everything into one deal. But also, just because your sponsor has a really good track record, that doesn't mean you can't vet the next deal that they do. You really need to focus on that. Make sure that they have a great debt strategy. They're not over leveraged, especially when you're putting in larger dollars. That was one story that I was like, oh my gosh, man, it could have
Yeah.
avoided so easily just with a little research.
Yeah. Yeah. I remember that story. And a lot of times, people say it's about the jockey, not the horse. But you do have to pay attention to market dynamics and what's going on in the market. That's why we pay close attention to macroeconomic trends, just to see like where the market's going. And since we're in it, we generally have a decent sense of what's going on. But I think because the market was so heated, everyone kind of loses sight and got a little greedy, perhaps. and they're not thinking about diversification. They're thinking about, sipping Mai Tais on a beach. So the story that I think it wasn't really a story, but it was a conversation I had that really stuck with me was, I was talking with like a fund of fund manager, and, just talking about the kind of deals they're looking for. And what surprised me is they're still looking for these quick turn and burn projects. They're looking for like max 3 year deals. And it's like, we're talking to them about how we operate, and we're looking like, 7 years, right? So that was really surprising to me. I get that. That's been the trend the last, 4 or 5 years, but now everyone's talking about, getting into longer term deals, 5 to 10 years, long term
Should
fixed
be.
rate debt, all
You
that
should
stuff.
be. You should be. Not everyone
Yeah.
is, but you
Not
should.
everyone, obviously, but that
What,
that
what,
that
what we
was that
saw,
was very surprising.
yeah, what we saw in those 3 years is not normal. Real estate should be considered a long-term investment. Um, let's pivot here a little bit. You brought up Mai Tais. Uh, we were in Salt Lake City. I'd never been there. Was really excited to try, some of the local restaurants, and somehow we ended up at
At
Benihana's
Benihana's.
Nasty. I don't know. And you got a Mai Tai there, which
I
was,
got a Mai Tai, yeah.
um, but yeah, well, I wanted to ask you. So talk about kind of this idea of coming out of the cave. So yeah, there was a lot of doom and gloom. A lot of LPs got hurt. Um, we see a lot of opportunity in the multifamily market, and we were just kind of going over some of these numbers. We had some great speakers there, and one of the numbers or the charts that stuck out to me the most, and we just talked about this, was kind of the disparity between the cost of renting right now in the United States compared to the cost of owning a home, given where interest rates are and just the cost of owning a home. And I think you wrote those numbers down, but I believe renting, the average rent across the United States is just over $1,800.
Correct. Yep. Yep.
And owning a home, when you factor everything in, um, we're looking at just under $3,100. So there's a huge gap there. And for multifamily operators, people who are able to hold on to a deal, to structure it correctly, which we do, um, we've got a lot of opportunity there for a long period of time for the cost of rent to catch up to the cost of owning a home, which bodes
Mhm.
well for us as syndicators of multifamily real estate.
Yeah, and what's interesting too is, you know, there was a lot of development that started, the last few years, and all of that's being delivered right now in the multifamily space specifically. But no one else is building right now. The cost to build is too high. Interest rates are too high. Labor shortages, lumber prices, tariffs come into play right now, of course, and so no one's starting to build or develop much of anything. And so in most markets, what we're going to see after like Q2 this year is no more new deliveries in the multifamily space, at least speaking on a national level. And what's that going to do to rent prices? It will likely push them up, because actually all the supply that's been delivered now, you would think like, oh, well, they're building too much. They're actually not, because it's getting absorbed. I think it's still sitting at like 94% occupancy rate. So it's all getting absorbed. But once all that's done, that's going to push rents up. But like you were saying, that delta between 1,800 and 3,000, even if rents go up 5-10% year over year for a few years, it's still going to be much, much cheaper to rent than to own.